heart of where innovation, money, and power collide in Silicon Valley and beyond. This is Bloomberg Technology with Caroline Hyde and Ed Ludlow.
Caroline Hyde of Bloomberg's World Headquarters in New York.
And I'm Ed Ludlow in San Francisco. This is Bloomberg Technology.
Coming up, crypto assets, they surge as a court overturns the SEC and paves the way for the first US Bitcoin ETF. We'll keep you covered throughout the hour.
Plus, we'll bring you the latest from the earnings front as China's PDD surges amid a revenue beat and Xiaomi tops profit estimates. More ahead.
And Apollo IO raises $100 million to reach a $1.6 billion valuation, an up round. We'll sit down with the CEO later this hour to discuss. But first, well, let's hone in on what has been the story of the last hour, Ed. Bitcoin surging, that sudden move to the upside. We're back in that $27,000 range on the OG of the crypto space, up 5.6%. Why? Because it seems as though this federal court has gone against the grain of the SEC, has decided that maybe we can carve a way for a spot Bitcoin ETF. This is all about the grayscale ruling, Ed.
Yeah, and we're also seeing that unsurprisingly play out in crypto-related stocks. Coinbase, for example, jumping by the most in more than 6 weeks. Our colleagues at Bloomberg Intelligence have a note out that kind of applies to all of these names, that each part of the universe related to crypto may benefit as more ETFs get approved, but they do note that there are multiple applications, right? So BlackRock being one institution that has an ETF application in. How does Coinbase benefit, as an example, from servicing those, up 13.4%? I think we've got to go to the understanding what has happened. It was a bit of a surprise. Let's bring in Bloomberg's Sonali Basak. And I guess a good place to start, Sonali, is what did the appeals court say about the original SEC decision to block an application for a Bitcoin ETF?
Now, I think the part that's very important here, Ed, is this idea that the denial of Grayscale's proposal, and this is according to the ruling, that the denial was arbitrary and capricious because the commission failed to explain the difference of treatment of similar products, which was a key part of the Grayscale argument here. When you look at the decision here by the court, and remember there were 3 judges that ruled in Grayscale's favor, there is a process that you have to understand. It's this idea that there are now 45 days in which both sides review this ruling, and the SEC could always push back. Now, the other thing that is a big open question for Grayscale is the idea of whether they have to refile for an ETF. Remember, when you look at Grayscale's filing relative to many other filings, including BlackRock's own filing, is this idea of a surveillance sharing agreement. That is something that has largely been said to be benefiting some of the filings such as BlackRock's. Actually, in the next hour or so, we're also going to be speaking to Coinbase's top lawyer about the benefits of, for example, a surveillance sharing agreement in which Coinbase has been a big part of that push. It is unclear how soon Grayscale can get from GBTC to an ETF conversion. And really, right now, when you look at GBTC, it has narrowed. The discount to its net asset value has narrowed quite meaningfully. But in recent years, the reason to hold GBTC has really become part of the idea that it would eventually convert to an ETF. Even just today, in the wake of the ruling, you were looking this morning at a 25% nearly discount to net asset value that has narrowed to 15%. And so you are seeing it come much closer to its net asset value in the wake of this ruling, in the expectation of, even with this uncertainty, this is still a large win for Grayscale and the crypto industry. And you are seeing, to the point you're making earlier, Bitcoin prices and other crypto-related stocks rise in synchrony.
SEC saying that the agency is reviewing the court decision on Grayscale. And of course, Grayscale anticipating what $5.7 billion could be unearthed, value could be sort of given back to the investor base if indeed it could turn from a trust into an ETF. Sonali Basak all over the sort of nuance and really going into some of the micro, but let's go a bit more macro, what this means for the industry. I'm pleased to say Aya Kantorovich is with us. She is the co-founder and co-CEO of Fractal. It's an infrastructure provider for institutional crypto trading on-chain. Does this lure in more institutional players? Does this mean that this is almost a safer space to get into now?
Absolutely. And you can see that in terms of overall market sentiment. So CoinShares published a very interesting report this morning that showed the outflow of dollars into crypto products, institutional products, was at its highest similar to March during the banking crisis. And so overall sentiment was really negative leading into this news. And I think to all the points mentioned before, the market was really caught off guard in terms of the announcement this morning. It's really great. It changes the sentiment in the U.S. and globally for institutions around this is moving forward. We're actually going to get the guidelines we've been looking for in terms of how to approach the space at large.
And go global for a moment with us, because look, other places have spot Bitcoin ETFs. What has been the US's issue with it? What more broadly have you felt is different with the SEC versus other regulators?
At a high level, it's really the different players that are in the space today, whether it is on the fact of the SEC working closely with Coinbase, and obviously there's a lawsuit there that they're working through the SEC and Grayscale. There's a bunch of intermediaries today that the SEC is working with, and it is just simply unclear in terms of how the SEC is going to regulate versus them pushing out a rule book or Congress having to just take the step and make guidelines for everyone in the United States to follow. And unfortunately, even if you compare to the UK with MICA, we just haven't seen that level of proactive guidelines in the United States.
Judge Naomi Rao, who was on the appeals panel, pointed out that specifically the SEC's treatment of Grayscale was arbitrary and capricious because they hadn't treated others in the same way. And our colleague Katie Greifeld, who leads our ETF coverage, points out that this is just one thing that might happen this week. There's a deadline Friday for BlackRock. There's a 21 shares Invesco deadline Saturday. What happens next, to your mind?
Yeah, again, I think the market was just simply caught off guard. We were expecting this GBTC news to come out in the last 2 weeks. And so on the backs of macro, on the backs of Jackson Hole, you're just seeing that the market was not expecting this news, and overall sentiment was negative. Implied volatility was at its lowest. And so really what that sets us up for is a very volatile Q3 and Q4. We're probably going to see the next 3 months have a lot of activity between these different players. And listen, the legal bandwidth of BlackRock and Fidelity, as well as ARK, is going to be far, far larger than some of the crypto players. And we will likely see those conversations get pushed further than what we've seen to date. So it's very exciting for the United States.
Who benefits the most from this? If an ETF's approved, beyond the ETF provider themselves, who wins?
Institutional investors. And really, the reason they win is institutional investors are looking for regulated paths to get exposure to these assets in structures that they're used to in traditional finance. And that just hasn't been available yet today in the United States. And so really, this is a huge push forward for us. We've always said that the institutional wave is coming, but it really can't come until we have very simple regulated products available in the market. And this is a bit push forward towards that.
And that's exactly what Fractal's all about. I mean, a spot ETF is pretty basic at best, a futures ETF too. You're thinking about options offerings. You're thinking about how you can get basically traditional finance, the TradFi world, to see what they can do in normal finance and bring it to crypto. How easier or slower process is that?
That's exactly right. It's a slow process only because it's taken so long for us to get this to this first base with the spot ETF. But to your point, once we get the spot ETF, it's going to be so much clearer for us to be able to give access. You saw Coinbase, CME, who are all able to trade futures in the United States. And that took a long time for that to happen as well in the States. And so you're able to see a path forward for us to really be able to offer not only options, but structured products in a regulated way that institutions are comfortable getting access to. It's really very exciting.
Great to have you here. So we'll walk us all through it, the sort of ramifications more broadly of this very specific ruling that's come from the appeals court. Aya Kantorovich, of course, is from Fractal. She's based here in New York. And over to you in San Francisco. What else are we looking at?
Yeah, some breaking news crossing the Bloomberg. Apple has set September 12th as the date for its event for the launch of the iPhone 15, its new watches. Actually, my invite has just hit my inbox, which is good news for Bloomberg Technology. But Mark Gurman had reported September 12th would be the date. Some of the updates we're expecting on the iPhone 15, both hardware-related and OS-related. Not doing much in the moment to move the needle on the stock. We're up 1.8% on Apple shares. But again, a lot of questions over what we'll get with the iPhone 15 at that event in Cupertino. Now, coming up here on Bloomberg Technology, the sales slump for tech could be bottoming out. That's what results from Xiaomi, PDD over in China, and Best Buy here in the United States have in common. We're going to recap those results. All coming up next. This is Bloomberg Technology. All right, we're checking in on some earnings movers out of China. These are the US-listed shares of some China tech names. PDD, top-line growth, 66%, way outperforming names like Alibaba and JD. But it's actually about Temu, their US-based business that we're kind of interested in. It came out at the Super Bowl with an ad. We'll dig into that with our team in a second. BYD doubled net income in the quarter. We'd already talked about how BYD had a record with both plug-in hybrids and battery electric cars in the quarter just gone, now showing up on the bottom line in terms of profit. NIO, a wider than expected quarterly loss, a completely different story in the EV space. And then Xiaomi, an interesting one in kind of the smartphone handset discussion, better than expected financial results. So much to unpick. I think what they all have in common is that we're getting some more signals about the Chinese economy and the Chinese consumer. Joining us with more, Bloomberg's Isabel Lee in New York and Henry Wren out in London. Henry, let's start with you with some of the specific names. I think we'll start with Xiaomi first, because this was one that was a little bit surprising to some investors.
Yeah, so Xiaomi's revenue fell by about 4% during the last quarter, but that decline has been better than analyst expectations. So that does show that the smartphone market slump might have been past its worst period. Remember, Xiaomi sells smartphone devices to all over the world, so it's not just in mainland China, but also in India, in many emerging market countries, in Latin America, some parts of Europe as well. So its results does seem to be a barometer for the global smartphone market sentiment. And remember that Xiaomi is also prioritizing its profitability, and it's pushing through its strategy for premium offerings, and it does seem to be bearing fruit. Its average selling price in China has expanded by 24% in the last quarter, and the company said on earnings call that it seeks to expand its strategy to not just in China but also overseas. It says we just need to focus on these premium products like these foldable phones, and we do well in this category.
It's interesting, isn't it, that they're saying, yeah, let's go for a higher price point. Let's actually still be thinking about overall profitability over growth when their overall macroeconomy, Isabel, is in a pretty painful place. We just look at how much they're having to up the ante with what we understand going to be cutting mortgage rates, for example, to try and spur on the Chinese economy. What do any of these earnings really tell us about that?
So I think these two, and Henry can go way into more detail, especially with PDD, they're good earnings. As you can see, the stocks are really just reacting very positively to them. But I think they come with a nuance. So for instance, just to touch on lightly on PDD, its focus is more lower income consumers. So then that might bode well for China's faltering economy. So it kind of works reverse in that way. But Chinese economy still really isn't doing as well. Nearly every day, you see one gloomy headline after the other. For instance, today we have Country Garden Holdings. It's a big property giant. It's making fresh efforts to avoid a default. And then we have China Great Wall Asset Management. That's a state debt-run manager, and it's also suffering a bond slump. So one after the other, this ceaseless warning we're just seeing, especially from the credit market, is just really underscoring one thing, that the economy is weak. And to your point, we also have a lot of developments in the regional bank space, in the mortgage space. So it's not looking that good just yet. Although, I mean, it's not all gloom and doom, because as we can see, some standout companies like PDD and Xiaomi are doing well. So sometimes what's good for one thing can be bad for another.
You know, Henry was showing that big jump on the PDD ADR's US-listed shares. You know, there's a story here about them beating out other domestic Chinese names in terms of top-line growth. But we learned a lot about their US business. That we don't discuss PDD a lot on this show. Just explain what happened in the quarter.
Yeah, sure. So the overall results were good, as we can see in the market reaction. It's a sharp positive reaction from investors, 20% of share price expansion like during the session. But as you said, the focus is really on Temu, its budget shopping app overseas. That app has been expanding very fast in Europe, but as well as in US as well. So the company disclosed very little about its Temu shopping app, but it does include that in one of its lines called transactional services revenue. So that transactional services revenue includes some things, including the Temu, the international business, but also the grocery buying business. But that revenue has been well above analyst estimates. So it does seem to show that Temu has been gaining traction overseas. However, there's another concern. It's on the profitability side, on the margin. So the company is expanding overseas, so it's investing more, so the margins could be hit because of that.
We want to thank both of you, of course, Henry Wren, Isabel Lee, across the micro picture of China, and indeed a little bit of what the US consumer is telling us as well. And let's dig in there for a moment, because Best Buy says that, look, it's reached the low point in tech demand after a pretty strong second quarter report pointed to an uptick, or maybe at least a bottoming in demand for consumer electronics and household appliances. Let's go to our own Brendan Case, who's in Dallas with more. Look, it's still pretty ugly in the quarter just gone, but it seems as though maybe they think there's a turning of the tide.
Yeah, what they're saying is that they're starting to see light at the end of the tunnel. The backdrop, of course, here is that the sales declines at Best Buy have been among the biggest, in the world of big U.S. retailers. And what they're saying now is that, they're starting to get a little bit less bad, and they have a line of sight to, being kind of flat, maybe even growing a little bit next year.
They also said that short refresh cycles in the tech are being driven by, guess what, Caroline? Artificial intelligence. Our thanks to Bloomberg's Brendan Case. Now, coming up here on the show, we're going to talk about the state of buy now, pay later, and speak to a CEO of a company that launches in opposition to the movement. This is Bloomberg.
Fintech Affirm is betting consumers want to decide in real time whether or not to pay interest on purchases. This is the Affirm card. It looks just like any other credit or debit card. The difference is the app gives users a real-time choice to pay up front like a debit card or pay later, spread over time, and often including interest like a credit card. I met up with Affirm's CEO Max Levchin to find out how it works. First, find something to buy. Max wanted to get himself a burrito. It has lower value, so makes sense to pay up front. Tap or swipe the card and boop, funds will get pulled from a linked bank account. But bigger transactions, say more than $100, you can pay with the card, go into the app, and then choose to split the purchase up over time after you've already checked out. You have up to 24 hours after the purchase to do so. Say it's a big purchase you've had your eye on for some time. You can also request a payment plan in the app before you check out. Affirm has both interest-free and interest-bearing payment plans, and you can adjust the timeline for the repayment.
Just a very sensible idea that you should not be paying interest on coffee and donuts and breakfast burritos like I thought. If you're going to pay any interest at all, you should only do it deliberately and on things you have consciously decided are worth paying over time.
Options available will depend on your creditworthiness, the size of the purchase, and whether you choose to split ahead of time or after you buy.
Just setting out the simple idea of why spreading payments over time and avoiding interest on small payments is worth it. Joining us now is Michael Hirschfield, Accrue Savings founder and CEO. Accrue is the first alternative payment solution in the Save Now, Buy Later category, launched in opposition to the Buy Now, Pay Later craze. I think, Michael, let's just start with what you heard from Affirm and Max Levchin. Their argument's simple. Something nominal, no point in paying interest. But if it's bigger and you plan it, you can pay interest over time. What do you make of that idea?
Well, it's not just about Affirm, right? Buy Now, Pay Later has grown so much in the last 10 years, and it's not just about Buy Now, Pay Later. We've seen short-term consumer credit over the last 30, 40 years balloon. It's all not negative. There's good things about it. Exposure to credit can be positive. But the reality is we have $1 trillion of credit card debt in the United States. It is growing. You're seeing real delinquency, a rise in delinquency in the last quarter in the United States. That says something to the American to retailers. They should be aware that there's some pain that's going on related to consumer behavior. As we have innovated for years, decades around short-term consumer credit, co-branded credit cards, buy now, pay later, there is an overextension here, and there needs to be an alternative path around payment diversity.
Okay, and so say you're pitting yourself against, a pretty wise and savvy user of a buy now, pay later, who is using it for the ways in which Max foresees, that they're just staggering their payments, they're keeping an eye on it, they're not getting themselves run up in debt. What is your offering at Accrue going to tempt them to you for?
I mean, a majority of Americans right now are actively saving for something they want in their life. Like we have continued to push, as retailers continue to push, and as a society we continue to push credit options to consumers. And so there is always a place for short-term consumer credit. I think that the average consumer needs it, but that doesn't mean there shouldn't be an alternative way. When you see we see this right now around a rising amount of household savings in the United States. And the idea of a stored wallet in Starbucks, obviously a very successful wallet experience where people deposit money into their Starbucks wallet to purchase in the store. This isn't about replacing what exists today, which is the rise in buy now, pay later or co-branded credit cards. It's about seeing where Gen Zers are, where are millennials right now. They are spending differently. They want to engage the brand differently. It's not just about the old way. I think Max articulates that very clearly. But we have seen an overextension. Where can you go and not use credit is the big question. And consumers want an alternative, which is savings.
Yeah.
Obviously, we've seen a tremendous growth. I mean, we're only 2 years old. We've grown quite rapidly, and we will be launching with a number of large retailers, some of the largest retailers in the United States, because of that awareness.
Yeah, you're backed by Henry Kravis, Tiger Global. You've got some funds, but I'm interested in when we're suddenly seeing high yield accounts offering 4, 5, more than 6%. Why should I not just take money from the savings I have in a bank where I've accrued interest and instead be putting it directly into, for example, a Casper offering on Accrue? I don't really see the upside.
Well, to be fair, most Americans don't have access to high yield savings accounts. So the average American needs to create a framework in which they do. They're depositing money on a regular basis to go on a trip. Or potentially they're using credit and they're going, 1 in 5 Americans right now are going to credit card debt to go on a trip. The reality is there are many Americans that need the support, that need that support from the brand that have pushed credit to them for a long time for them to go on the experience they want in their life. And frankly, like that's not necessarily fair to compare directly to an interest yield. Our reward is compounded on every deposit. So it's actually 5x, 6x, 10x of what a particular yield would be from a high interest. Because obviously you deposit $5 one month, $10 another month, and that's not a compound. You're not compounding. The compound changes over time as it relates to it. That's it. Every dollar you come, you get 5% or 10% or 50%, depending on that.
We're going to have to wrap it up there. But thanks for breaking down the business model. Michael Hirschfeld there, Accrue Savings founder and CEO. From New York and San Francisco, this is Bloomberg Technology. Welcome back to Bloomberg Technology. I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco. Let's get to talking tech. And first up, OpenAI has now a corporate version of ChatGPT with privacy safeguards and added features like longer text prompts. This in an effort to make money from its well-known chatbot. And speaking of AI, Google is adding AI tools from companies like Meta and Anthropic to its cloud platform, weaving more generative AI into its products and positioning itself as a one-stop shop for cloud customers seeking to tap into the technology. Plus, Senate Majority Leader Chuck Schumer plans to bring together several tech industry chiefs to discuss the ramifications of AI. Next month, that meeting includes Tesla CEO Elon Musk, Meta CEO Mark Zuckerberg, but also the CEOs of Google, Microsoft, and many others. This will be the first of Schumer's AI Insight forums aimed at giving Congress more influence over the future of AI. Caroline.
No mention of a cage match. Meanwhile, let's stick with AI, though. How is, it changing the game of basically everything, but particularly your wealth management? Let's talk about it with Brad Genzer, founder, CTO of Father, a startup focused on utilizing pretty cutting-edge technology to advance wealth management in particularly the sort of mass affluent area, I'd suppose. And you, of course, were busy building the AI team over at Goldman when it came back to sort of the private wealth management part. How have you brought that over with Father? What are you offering that's different?
Hi, Caroline. First, Ed, Caroline, thanks for having me on. It's fun to be here. It's a fun time to be in wealth management technology. And when you talk to someone like me, it's really been 4 years in the trenches or farther, kind of grinding away and realizing the opportunity ahead. And now we have these big moments where it comes out to the public. So we've been at this for a very long time. And just really quickly to sort of adjust there, we are focused on kind of the core high net worth market. But you'll find that if you use technology, you can actually broaden your audience. It's an operational problem. We put these wealth management kind of verticals around wealth because it's profitable to operationally serve higher net worth, but it's all the same operations all the way down. So just to your question about how we're bringing forth AI, we broadly believe that quantitative methods are going to help us to meet the opportunity in our industry. And if we look at how our industry is covering the opportunity, there's about $420 trillion of net worth in the United States. And if I add up what the biggest players are doing, it's hard for me to get to 20 trillion. So we're talking about a massive opportunity to bring everything out towards out to a broader set of people, and that's what AI can bring us.
But can it, in the here and the now, when we're still looking at perhaps regulatory headwinds, at least? It seems to be garnering more oversight from Gary Gensler.
Well, it certainly does seem to be garnering more oversight. But I think that we're fortunate in this time to say to have someone heading the SEC, for example, who knows about this technology and actually is able to talk about it. Because I don't know that you have that across the board in government right now. If you look back at how Gary Gensler has written about AI technology, he wrote a paper in 2020. This is 3 years ago, 1 year after Farther was founded, and this is really the time that we started to see all the pieces come together for AI to start delivering. So he has a mission to do here and now. It's to protect investors. I hope that as we go forward, he also realizes and sort of leans into protect investors, but also get maximum number of people exposure to markets, because it's a true miracle being in the markets.
Brad, could you explain how your technology or proprietary tech works? I see that on your website you still talk up the experience of the human advisors that work with you at Father.
Yes, and I think it's really, really important that you hit on that, Ed, that we fundamentally believe, and this is from deep knowledge of the technology, as someone who's been a leader and been around it for a very, very long time, that humans are required to have a great wealth experience and will be for the foreseeable future. I think that if you ask anyone, and we ask people, hey, would you like AI to fully manage your money in a very, very general way? People say, well, one, what does it mean to manage my money? And advisors help in that. And also, they tend to say, no, we want to interact with people. It's just that technology can allow more human interaction, really.
Brad, you talked about your leadership of the technology. You were at Goldman Sachs for several years. Has David Solomon phoned you up and said, Brad, I need your help with this AI thing. I don't get it. Come in here and help us.
I don't know. I must be off his text chain. And Chuck Schumer also hasn't texted me yet. I'm still waiting for the invite.
Well, we'll get. I'm sure you'll get wind to them, and with some of the backers that you have, of course, you've got backers like Bessemer Ventures, Khosla Ventures. Of course, these sort of VCs have the ear in Washington many a time. I'm interested in the high net worth professionals that you serve. What weren't they getting when you were at Goldman? Why did you feel you had to get out, had to serve, and build something different?
So when you think about where we are, if we look back at the history of wealth management, we had the Fidelities of the world, Vanguards of the world, who were bringing mutual funds. That's like execution and some strategy involved. What we really get to do now in AI is we get to have a deeply personalized plan. And personalization is an overused thing in our industry, but really we are fully contextualizing and able to fully contextualize the relationship. So that's based on your taxes, where you live, what's going on in your bank accounts, and we can broaden the breadth of what wealth management is to provide a much better experience and deliver it at scale. And again, I've talked about how we're not really covering the opportunity that well as an industry.
Brad, how concerned are your clients about their data protection of it and how it's used. And, by extension, I already asked you about the technology, but is it a case that you're kind of technology agnostic? You take an existing large language model and vectorize your own client data, or how does that work?
So one of the things that, and this is where you'll continue to hear me say as I talk about AI and the broad market, we have a lot of frameworks in history that's already been solved around these problems. In wealth management, discretion is one of the most important things that advisors bring to the table. You are talking about the most deeply sensitive subjects in your life. You're talking about how you feel about your family. You're talking about how you feel about your job. And that has always been a core tenet of a good wealth advisor, and it extends to technology as well. So when we think about data and managing it, we actually don't ever send your personal data to large language models. We may send templates to populate that data, but we retain all of that data. And as you pointed to, ChatGPT has an enterprise version, but still, we're waiting for more robust tools before we start sending data across.
Brad Genser, founder and CTO at Father. Just really interesting to draw the link between the technology and your industry. Thank you so much for your time. Now, coming up here on Bloomberg Technology, Apollo.io, a platform for sales and marketing workflow tools, nabs a $1.6 billion valuation. Our exclusive conversation coming up with Apollo.io CEO Tim Jeng and Bain Ventures' Merritt Hummer. That's coming up next, Caro.
Yeah, meanwhile, before we pivot to the world of VC, let's just shine a light on what's happening in crypto. It is the story of the day, it feels like. Up 7% on Bitcoin at the moment. In fact, the biggest move for the asset since March of 2023. So clearly managing to trade, though basically at its highest since August 16th. Remember, we have significantly sold off throughout the month of August, as we have across most of the tech asset classes. From New York and San Francisco, this is Bloomberg Technology.
Sales tech platform Apollo.io has raised $100 million in new financing, placing it at a $1.6 billion valuation. The Series D investment was led by Bain Capital Ventures with participation from existing investors, including Sequoia Capital, Tribe Capital, and Nexus Venture Partners, at a higher valuation than it had before. Let's bring in Apollo.io CEO Tim Jeng and Bain Ventures partner Merritt Hummer for this. Merritt, I'll start with you. Apollo's a great example of a company where AI is basically adding to the value and utility of customer data. But you point out their track record is why you were interested to do this round, and indeed at a higher valuation.
Yes, absolutely. So, we were really struck by the fact that Apollo is growing so quickly and so efficiently at scale, more so than the vast majority of companies in the market today. And it was a very unusual combination of characteristics that got us very excited about the company.
Tim, you have more than 500,000 companies, millions of users. Why do you need $100 million?
Yeah, we feel like it's the perfect time for us to raise money right now. We've grown our revenue over 9x in the last couple of years. We're going after a giant market. Although we're still really efficient, we just feel like now is the perfect time to pour fuel onto the fire.
Okay, let's talk about that fuel. You said you're going to be investing in product, Tim. You're going to be investing in R&D, but also talent. Just how expensive has that talent become, and where do you add to it, Tim?
Yeah, we're definitely an R&D company first and foremost. So we're investing over 60% of our revenue typically on R&D, hiring very, very globally. The market's definitely not as crazy as it was before in terms of the talent market. But hiring a lot of engineers, designers, product PMs across the world, especially within AI.
Talking about things that aren't as crazy, well, funding isn't as crazy at the moment, Merritt, and it's been a tougher time for venture capitalists who've just raised big funds, just as Bain Ventures has, to be trying to allocate in this environment where perhaps there's fewer to choose from. What sort of growth do you want to see from companies? Is it all about annual recurring revenues? Is it about being able to retrench on spending and ensure they're focused on the bottom line? Is there a rule of thumb here?
Yes, it's a great question, very timely question. I think what we've seen in the market is, a couple of years ago, top line momentum was really the primary thing that investors were paying attention to in the venture space, and I think that has really shifted to thinking more about efficient growth. What is the investment required to drive that top line momentum? And that's where Apollo really stands out. When you look at their efficient growth metrics like Rule of 40, they're really best in class, and that's what got us so excited about making the investment.
Tim, what I find interesting about your company is you're based here in San Francisco, but you are remote first. It's a topic we've discussed on the show quite a lot recently. Just explain your thesis of why that's the best way to work.
Yeah, definitely. I mean, there's so much talent all around the world, and we definitely just want the best access to talent, regardless of where they're located. Especially, there's definitely a exodus of talent from SF as well. It's still the Bay Area is still the center of tech, but now great talent is everywhere in the world. So really.
Mary, I know a number of VC board members that don't agree with that thesis. They want to see their portfolio companies work together, be in one place. What do you make of the remote work position that Apollo has?
Yeah, I think our view is there's not one size fits all answer to that. I think for every company it's different, and for some companies a distributed workforce can work really well depending on the nature of what they do, and for others it's really important to be centrally located in one place.
I'm just going to go back to Tim, what it is that you offer. I mean, I think you're the first sales tech unicorn minted in 2023, and you've been sort of saying what makes you stand out, and of course it's about allowing sales reps to do what exactly that is, to sell, to not be having to permanently moving between tools and having cumbersome interaction with CRM. But one thing that took my eye was the fact that you were saying, look, some of your competitors, dare I name one of them, ZoomInfo, for example, you say they seem unified, but they're not because they've acquired. Does that therefore mean you won't be using funds to ever acquire other companies?
Never say never, but we're really focused on building the absolute best user experience for the end user. From day one, our goal is to build a unified end-to-end solution from the bottoms up that is the simplest to use and most accessible to get started and the most delightful user experience. We've now built the most number one rated product for sales. It's the most loved product, and a lot of that has been the way that we've architected the product from day one.
Mary, on this program, we make the distinction between AI native and sort of AI adjacent companies, those set to most benefit from this next generation of artificial intelligence technology. Does your investment thesis fit that split as well?
Absolutely, although I would frame it differently. I would call it AI enabled. So Apollo is absolutely an AI company, but it had an established distribution and product that wasn't AI native from the start, but has unique right to embed AI into the product over time.
We want to thank both of you. Fascinating to be able to get into the inner workings of what makes an up round. We congratulate on Apollo IO, of course, CEO Tim Zhang and Bain Ventures partner Merit Hammer. Let's get you some breaking news all in the world of AI. We just finished there with Ed, and let's bring it back to NVIDIA. Shares up more than 4%. And indeed, Alphabet just staying a little bit higher. We've got some news that indeed they're going to be deepening some of their relationship. Google Cloud, in fact, with NVIDIA are expanding their partnership to advance AI computing. So really starting to see the, overall building blocks coming into Google Cloud offering. Meanwhile, coming up, let's talk about other partnerships. Walmart, for example, taking to the skies by teaming up with Wing, or drone deliveries more generally. Wing, also part of Alphabet. The CFO, Shannon Nash, is going to be joining us. This is Bloomberg Technology.
So Walmart is planning its longest distance drone deliveries yet by teaming up with Alphabet's Wing unit at 2 Dallas area stores. The Wing drones will be able to drop off food and household essentials as far as 6 miles from the stores. Let's bring in Wing CFO Shannon Nash, who's here with me in San Francisco. There is a caveat, which is that a spotter is needed to look out for any aircraft that can't transmit their location. Just explain that caveat and how the technology works.
So at Wing, we have permission from the FAA to fly what's called beyond the visual line of sight.
Right.
So for us, we don't have the said spotter that you're talking about. The way that we operate is we have somebody, and we have pilots that are able to really look at the area, if you will, in terms of where our drones are flying, as opposed to looking at, I think people think that there's somebody just looking at the drone and flying and seeing how far it can go. I've had people say they think there's somebody with a joystick actually controlling the drone. We're completely autonomous. And so that's why we're super excited about this opportunity with
You're the
Walmart.
CFO of Wing, so I've got to ask, it's 2 stores, but big stores in Dallas. How big a deal is this for Wing, commercially speaking?
Yeah, this is a huge deal. Let's just take a step back. Wing has operated and done over 350,000 commercial deliveries in 3 continents. This allows us to expand in the U.S. With this Walmart partnership, we will be able to reach over 60,000 households in the Dallas-Fort Worth area. And so this is again, just part of our scaling opportunity, and we're super excited to be working with Walmart.
What sort of demand are you seeing? How many people are wanting to rush to get to the app to make sure that they can, in the Dallas area, receive these sorts of, deliveries that we just saw on our screen?
Yeah, we spend a lot of time working on community engagement and really engaging on the need for our services in the local area. We've already been operating in Dallas. We have a partnership with Walgreens, and people have been asking for us to do more. So we're super excited that we're able to come back to the Dallas area, not only do more with Walmart, we expanded our hours, and we'll be able to reach a lot more of the Dallas-Fort Worth area.
And it's interesting, medical drone delivery, also a focus of yours in Ireland, for example. I'm really interested, though, in what this stepping stone means, because 60,000, it's a lot of people. But it's certainly not the millions in the US. What gets us there? What sort of timeline, what sort of regulatory approval do you need so that me in New York can also get it delivered?
I think those are great questions, and we've spent a lot of time, working with industry partners on really expanding some of those approvals. I think, look, the reality is we are partnering with Walmart right now. That is the stepping stone to get to what you're talking about, where this is expanded to the millions. We think that we are building a safe, reliable, efficient drone delivery system that is capable of getting to those millions. And so this is the journey that we're taking, and Walmart is very important to us expanding in that way.
There's the sort of FAA regulation factor that impacts how quickly you can grow. But there's also different attitudes from different cities, states, retailers. Where do you feel like you're making most progress? Which areas are most supportive to deploying drone technology?
I think that so there was a study that Virginia Tech did in Christiansburg, Virginia, where actually we are doing drone delivery. And it showed that 90%, almost 90% of those who took that study were very positive about drone delivery and wanted it to come to their communities. We even just recently showcased a couple, Ed, who's in their 80s, who actually have had the most drone deliveries and set a world record. They've gotten over 1,200 deliveries in the last couple of years. And my favorite part about their 1,200 deliveries is they got almost 100 boxes of Girl Scouts delivered to their house. So we think the demand is there.
That's a brilliant story. I'm not going to ask how many eggs they got delivered as well, as I know you do that pretty efficiently. I mean, it needs some power players, some mass adoption, and people to really show how much this works. But ultimately, what are the things, are sort of the teething issues in your scaling? I mean, what about talent? What about bringing in the know-how to continue to expand and ensure that this delivery can happen so succinctly? Is it something that you think about a lot?
Absolutely. As most tech companies, innovative companies, you think about attracting and retaining the best talent out there. I think, look, we are very fortunate to be a part of Alphabet. Alphabet is our parent company. And so I think that, we continue to attract and try to retain the best talent out there. I think there's a lot of opportunities for people looking to get into new industries. I think drone delivery industry offers a lot of opportunity, and I think we're going to see a lot more talent coming into the industry.
We want to
Wing
thank
CFO Shannon Nash. Oh, sorry, Carrie.
No.
Wing CFO Shannon Nash. I get excited about drones. You know that I do. And it's interesting to see some real-world deployment. Carrie.
Yeah, I get excited about breaking news as well, Ed, which is entirely why I tried to step on your thunder there a little bit, because we've got some news coming from X, Musk's X, in fact, we understand is going to allow political advertising. The company is saying in a blog post. When you go to the blog post, it's called Supporting People's Right to Accurate and Safe Political Discourse on X. And They're really talking about how they're currently expanding their safety and elections teams to focus on combating manipulation, servicing inauthentic accounts, and closely monitoring the platform for emerging threats. But notable, Ed, that they're actually thinking of beefing up teams in that area after the headcount cuts that we've seen in that business. Meanwhile,
yeah, look, it starts in the US. They're going to allow paid-for promoted political votes, but prohibit false or misleading content. Sounds familiar?
That does it from this edition of Bloomberg Technology. Tomorrow, we've got a big one. Michael Sonnenschein is going to be from Grayscale CEO, joining at 10:30 a.m. on that landmark ruling, that Ed.
Yeah, recap with the podcast wherever you get your podcasts, Apple, Spotify, and Bloomberg. This is Bloomberg.